Hello, Professor. This is Mon Jan presenting the financial report of the Camp World Holding Company. I chose this company instead of the company I chose because it has a much more complicated financial report that you gave us. First, I did some analysis research on the history of the company. Basically, it was founded back in 1960s. Was selling RV parts and supplies, and it start mail order service since 1969. And by 21st century, the company has expanded to 58 stores, and it went IPO on 2016. It raising 251 million, which is not a lot compared to today's IPO. And in 2024, it operating 215 stores in 43 United States, U.S. states. And here's the horizontal analysis of assets. Basically, the cash is decreasing, but the inventory and other different kind of current assets increase a lot, and also the non-current assets has some substantial increase of like 21.7% increase, which is substantial. However, on the other hand, the current liabilities also increase a lot. The non-current liabilities also increased significantly by 27%. Other long-term liabilities increased by 55%, and stakeholders' equity decreased a lot. And so the total situation is that the company has increased investment in assets but face higher long-term debt and reduced equity, which can impact financial flexibility. And here's the analysis of the revenue and expense. So the total revenue increased a little bit, and the expense, like the relative expenses, also increased even more, like 12% increase on revenue versus 25% increase on expense. And the impact on operating income is that the income from operation fell a lot, fell like 45%. Is quite sharp. And in terms of the net income, the floor plan interest decreased by 38.4%, and the tax receivable also decreased. So the net income dropped substantially, like 71.6%, and the diluted EPS fell also. So the conclusion is that the company demonstrated strong revenue growth but escalating cost of goods sold. So and the absence of one-time tax benefits in 2018 significantly impacted the profitability. So we need to focus on controlling SG&A and leveraging operational efficiencies. Next is the component percentage analysis of assets. So the cash and cash equivalents decreased, and the non-current assets increased. Also, the note payable decreased, among accounts payable increased, the total current liability decreased, and long-term debt increased, stakeholder equity decreased. It's relatively the same with the horizontal analysis we saw previously, and the balance sheet is showing a notable increased reliance on long-term financing and decreased equity proportion. So it's a leveraged growth strategy. It's kind of risky. Next is the analysis of revenue and cost. So marginal improvement in gross margin were offset by rising operation expenses, primarily from SG&A and depreciation. And lastly is the component percentage analysis of profitability. We can see that income decreased, the tax receivable did not occur. The floor plan is indicating a slight increased financial cost due to the interest expense. So overall, the net income dropped, and the net income attributed to non-controlling interest reduced. So the company faced significant headwinds in maintaining profitability due to rising operational costs and the absence of favorable one-time adjustment from prior years. And here are some of the key financial data we're focusing on. So first is the return on equity. It measures how efficiently the company generates profit from its equity. We can see a slight decrease, like 10% decrease. This could result from lower. I think it's just result from lower net income and reduced equity. And next is the earnings per share (EPS). It measures portion of net income allocated to each share, and the formula is the net income minus preferred dividends divided by average outstanding shares. We can see EPS dropped significantly by 65.6%, primarily due to the decline in net income. It indicates reduced shareholder profitability. And the total assets turnover ratio measures how efficiently the company utilizes assets to generate sales. The formula is net sales divided by average total sales. And the data is missing. The current ratio measures the company's ability to meet short-term obligations with current assets. In 2018 is 2.93. In 2017 is 2.38. So it's improved its current ratio by 0.55, indicating better liquidity management in 2018. So the company is in a strong position to convert short-term liability. And next is the price to earning, the P/E ratio. Definition is to measure how much investors are willing to pay per dollar of earnings. The formula is the current stock price divided by earnings per share. In 2018, it's increased by 6.24 points, suggesting higher investor confidence despite the declining earnings, and is kind of demonstrating that the company is leveraging more and more resource from outside, and long-term financing strategy is kind of forcing the investor to put more into this company. And in the end, would I buy the stock in Camping World Holdings? Not right now, because first of all, the declining profitability, and the net income fell significantly due to, and the EPS is dropping. It is indicating the company is struggling to convert revenue into profits, and the ROE is also declining. The lower return of shareholder is caused by reduced earning and a smaller equity base, and the operating cost is rising, and the market risks we can see from the high P/E ratio, because the company is leveraging its future or like long-term financing to gain the high P/E ratio. So I might buy the stock at a higher value than normal. It's given the steep decline in earnings. We should not be overly optimistic about it. So overall, we should not buy it right now. And here are the references. And thank you for paying attention.